What is negative yielding bonds? Why buy them? Why invest in an investment instrument where you actually lose money or you pay money for the benefit of investing in that instrument? Why has negative yielding bonds, government bonds, been on the incline in the world over the last few years? Hi, Eugenia at The Wealth Effect, and thank you for joining me. Right, so I've got this interesting article, and this article actually dates back from 2016 when it was already fairly fashionable, especially for developed or first world economies, to have quite a large number of negative yielding bonds. Now, just to position this conversation, the reason why we are sitting with lower and lower and lower interest rates in the world, and the reason why the high interest rates of the 70s, 80s, and the 90s will probably never be seen again, is because whenever there's a financial crisis, central banks have only one tool at their disposal, and that is reducing interest rates in order to artificially reinflate markets. And even if the economy really is dead, lower interest rates make money available cheaply to first borrowers of money. I'm talking about your large commercial entities that can get those funds at a cheap rate, and as a result, it helps them to stay afloat, even though they might not even be making profits. And also, it allows your large investment banks to invest and to push up further the prices of shares or stocks and market prices of investments, because they are getting that money at a very low rate. So when the economy slows down, when retail spending goes down by the markets, then the central banks say, let's just pump more money into the system, pump more currency into the system, make it available very, very cheaply. Now, there's no room to maneuver anymore. Interest rates have gone down considerably since the 2008 crisis in order to try and keep stimulating this bubble that the world has been in for a number of years now. So there's no more room to maneuver with interest rates because they've come down so far. That is why some countries have started to resort to negative interest rates. So why would anybody buy a bond? Now, a bond, of course, is a piece of paper. For instance, I take out a government bond. I pay $1 million for a piece of paper with a principal value of $1 million. And that means the government promises to pay me back at the maturity date, let's say 10 years from now, that $1 million plus the interest on it. Let's say it's a 2% coupon. They promise to pay me back $1 million plus that 2% interest, which will be $20,000. Now, in a negative yielding bond, they promise to pay me back that $1 million less the negative interest which they charge. In other words, I am losing money for investing in this instrument. So why would anybody do that? And I've been asking myself this question. I came across this article of 2016 of the Financial Times. So how can debt be negative yielding? So that's basically what I've explained to you now. As coupons and principal repayments are fixed at the time of the issue, the market price of the bond will fluctuate depending on how attractive its income is when compared to other bonds. So that is where the market influences it. So, right, the more people, the more investors that invest in a bond, the higher the price goes. And effectively, that means the effective interest rate on that bond comes down. So the interest rate on bonds are therefore effectively really determined by the market. Now, to reduce interbank lending rates, the Federal Reserve of the United States, for instance, or the European Central Bank would need to look at the interest rates that bonds are fetching in the market. So if these interest rates go down below zero, then Fed can say, you know what, look at how low the bond interest rates are. We can reduce the interest rates to our banking buddies so they can continuously make use of this big Ponzi scheme that we're living in order to enrich themselves. And somebody downstream has to pay for all this debt, all this money that we're pumping into the system. And that, my friends, is where inflation comes in. That is where taxes comes in, right? That is a theft and of purchasing power, and that is a theft of the regular people in an economy. They are paying the price of all this cheap money that's flooding the system by means of inflation and, of course, multiple taxes that have to be paid by citizens on their day-to-day living. Right, so why would people buy negative yielding debt? Right, so the cost of leaving the cash in on deposit with a bank has led companies and investors to seek out other safe assets. Again, you will be willing to accept a reduced price or reduced rate for some instrument if it is still better than what you get elsewhere. Right, so that is where deposit interest rates of 0.4%, for instance, that was in March 2016. So you're not even earning interest in your bank account. So why not go for something like a government bond, which is a liquid market, knowing that somebody will buy that bond from you more than likely, and you don't need to suffer that loss. Right. So short-dated investment-grade corporate bonds, that is where companies issue their own bonds in order for them to raise financing. So these offer negative yields, but they pay more than cash, as well as being relatively safe. Also because the central banks simply step up and bail out when it needs to. When these corporate bonds are wavering or commercial bank debts are wavering because of the cowboy business that the guys have been doing, the central banks simply step in. They create more money out of thin air and they buy these bonds up. In that way, they keep the bond price up because they keep a demand there for these bonds. And as a result, the effective rates of these bonds stay in a negative. So some investors may speculate that yields can fall even further, which will push up the price. So if the yields are now minus 1% of, let's say, a 2-year Japanese treasury bond, and we expect that the yields can fall even further, then we would be happy to buy the bond now because we can sell it again and still protect our savings now or our resources. So my question is, if you're expecting negative interest rates, and if you are happy to buy a bond with negative interest rates, in other words, where you know you're going to get back less money when you keep this bond to its maturity date, that to my mind shows that you as an investor, this market, the bond market, is expecting deflation. What is deflation? It's not as cool as it sounds. It's a reduction in prices. Everything becomes cheaper. Why does things become cheaper? Because the markets crash. The stock market goes down, the ETF market goes down. Even metals can go down, even cryptocurrencies in the beginning of a deflationary market can go down. So money is sucked out of the system. So only in that way will somebody be willing to buy something now which they know they can sell potentially at a lower price in the future, because they know that the way that the markets are going to fall will be faster, will outstrip the reduction in this value that they see. So one reason to think yield could go low is that the ECB is buying corporate bonds. Now, right here, this paragraph is what is wrong with the world monetary system. The ECB is not a producer of any form of value whatsoever. That's the European Central Bank. Very much like the US Federal Reserve. It doesn't create or produce any form of value. Where does it get trillions of dollars? Now, back in 2016, there were $7 trillion of negative yielding bonds. Today, 2019, there's $13 trillion. Now, please, if you want to understand what $1 trillion is, watch the video on my channel of Steve Knapp, which I have uploaded. I'm sure he doesn't mind, but that gives you an indication of what $1 trillion is. So where does all this money come from that the ECB and the US Fed are using? They're just printing this money. They have a license to create money from thin air, and that is what keeps this bond market up. Right, so that is why some investors are happy to buy bonds at a negative yield. Right, so the ECB's ultimate goal is to boost inflation and growth in the Eurozone. By lowering the cost of financing, it can help persuade companies to spend more money and directly lift demand. That is manipulation of markets. There's no free market system that we are living in in this world if central banks and federal reserves are doing this. Now, the unfortunate truth is that the way in which the US Federal Reserve have been, and the US government since 1971 at least, have been doing really criminal activity by defaulting on their gold owed to their trade partners, where they simply seized the convertibility from US dollars into gold. They simply said, you know what, we know we told you that you can exchange your US dollars for gold. That was the premise under which we have done business, but now we're telling you to take a hike. We are not doing that anymore. Right, so that is criminal, really. And what has been happening ever since then was that this huge inflationary bubble has been created by this money-making Ponzi scheme that we live in. As a result, we are sitting at a precipice. There is no soft landing, unfortunately. The free market needs to go its route. And this way is not going to happen because the can is simply being kicked down the road by the manipulation of central banks. Right, so I hope this is not too much information, but please have a look at this article. It's a very interesting read. So corporate treasurers say that small changes in interest rates are unlikely to make much difference of their investment or strategic plans. This is where we're sitting now. The market is reacting less and less and less to changes in interest rates, and there's no room to maneuver. What is the next thing that's going to happen? Are banks going to start to put negative interest rates on normal savings accounts like yours and mine? In other words, confiscating our money if we are not willing to spend it, right? That is trying to shock that life into that dead body that is really a zombie, to try and keep the zombie economy going. It's by forcing people to spend money to stimulate the economy by confiscating the money that they have in their bank accounts. That is negative interest rates. Now think about this. If you have your wealth stored in cryptocurrencies, nobody can confiscate it. Negative interest rates will not have any influence on you because it's censorship to resistant. It cannot be confiscated, and it's based on distributed ledger technology. So that is just something from my side to maybe think on. Right, so having cash is a problem for banks, investors, and companies. This means finding something to do with it and passing it on to someone else to spend. Right, so the ECB also has in mind something called the portfolio rebalancing effect, which means investors shifting their asset holdings away from very safe and unproductive assets like cash into riskier assets like corporate debt. Right, so read through this, very interesting. I've gone through it very quickly now, just a few highlights, and just something interesting here as well, also on negative yielding bonds. This article in the Financial Markets Journal by Martin Ackerman. Have a look at the last couple of paragraphs here. There's another issue at play here, which may in fact see negative interest rate bonds being suitable for retirement portfolios. Deflation remains a real risk for many parts of the world. Now, as you'll remember that I just said, was that you would possibly be willing to buy something now which you can probably redeem or maybe sell later for a reduced rate if you're expecting deflation, if you're expecting markets to crash and things to become more cheap. Then you would be willing to sacrifice a little bit now rather than a lot more in a few years. So so that's why he's saying yes, well, deflation remains a real risk for many parts of the world. And with prices falling, pension payouts could decline and a retirement fund could find liabilities falling over time. Okay, buying negative rate bonds will still result in asset matching liabilities. So bonds are no longer a safe haven risk-free asset of yours. This is an interesting, because bonds have always been seen as a risk-free asset because governments will never default on their debt. Now, strictly speaking, the US government, for instance, can just print the amount of money it needs to pay off the debt, but it is not as simple as that anymore. This monetary system has painted governments and central banks into a corner, and there's no way out of it except for the hard truth of a reset in the international economy, which will be painful, but is unfortunately the only way to go. And we need to position ourselves by means of holding real assets and real mediums of exchange, such as gold, silver, cryptocurrencies. Real assets, of course, could be property as well. It could be any means of life sustenance, anything real and tangible, but a medium of exchange you will always still need in order to transact if currencies collapse. And that is where gold, crypto, silver, etc. are going to be very useful. So as the 35-year bull market comes to an end, the risk-free nature will change swiftly into a return-free one. We would suggest that investors who can switch out of bonds and into equities, notably high dividend yield companies. Right, so, and the reason is that equities have been rising, especially in US, in the UK, and in Germany, etc. It's been rising because of this money printing. Stock markets have been inflated because of cheap money that's been given to your first recipients, your corporate investors and your corporate banks. And these shares of these companies have been rising even though they haven't been making any profits. So personally, I'm not very keen on equity investments, but it has been something lucrative over the last couple of years because of money printing. But it is a form of inflation. So please guard yourself against that. If you have any profits sitting in equities, perhaps consider taking some of those profits out and just putting it in an instrument that is inflation free, something like gold, something like silver, where there's no counterparty risk. In other words, that instrument that you have, that asset that you have, is not at the same time also somebody else's liability. There's no counterparty risk. So that's why it's important to have your funds in assets as well that will protect you against inflation. Because when markets crash, deflation will first set in. But then, however, after a couple of years, the governments and the central banks will be printing money, dropping it off with helicopters to try and kickstart this dead economy. And what's going to happen is they may very well pump the system too full of money. People will lose complete trust, and they will go out and spend every single cent that they have because they will lose trust in the currency, in the fiat currency system. Just finally, they will go out and spend all this money. What's that going to do? It's going to push up the demand for goods and services, and it's going to get the world into a hyperinflationary state. And that is where real assets like gold, silver, crypto, property will be valuable and will be the place to go. So this is not investment advice, but this is me sharing some important information with you, and I believe that it's important. Everybody should understand this and position yourself, because a wealth transfer in this world is coming and it's already happening, and you are living at an exciting time. So try and prepare yourself for whatever may come, and always take an approach of diversification. So this is me, Eugene, and thank you for watching. If you like this video, please click like, please click the subscribe button as well, and I will see you again next time. Thank you for watching.